Hey, Jared Jones, are you looking to refinance your home soon? I'm getting a lot of questions as what's the rate? When should I do it? Is it low? How's the future if I want to buy a house, if I want to buy an investment property, vacation home, or you have a home now and you want to take cash out of it, or COVID is putting some pressure on you financially and you've been hearing about skipping payments. How does that all work? Today I'm interviewing Jason Cota with one of the nation's top mortgage companies to discuss all that. Check it out.
Hey everybody, Jared Jones coming to you from Orlando, Florida, and I have a special guest on with me today. Jason Cota with Fairway Mortgage has been with my teams, at least as far as being our lending partner, and a very important piece in a role that serves our clients with regards to getting their financing needs met. And he's actually, in the last 30 days, become a clutch player in that we've had deals falling out. We've had, credit score changes and other lenders causing loans to be denied. And then all of a sudden we have to bring Jason in. With that, Jason, tell me about yourself. How long have you been in mortgage? And then, and tell me if you actually really do like lending. And then, yeah, tell us about yourself.
Sure. Thanks for having me. So I've been in mortgages and lending for 15 years now. Came from the Midwest and made my way out to California after college. And that's when I really got into real estate and financing. One of the things that I love the most about it is, do I like it? Yes, I absolutely love it. Every loan is different. Every borrower is different. They've got a different situation. The best part about it is being able to help an individual or their family, find that home and get them their keys at the end of the day.
Let me start with this. One of the most common questions I get is, I'm considering refinancing my house. My house has been going up in value. There's some uncertainty in the market. I may want to take some cash out. A lot of focus on the interest rates as of late because they've been swinging back and forth. So kind of give me an idea of where we are now. And then give me your best guess at where you kind of see things going, 4 or 5 months from now.
Sure. So right now, as far as where rates are at, we're almost at, historic lows. In the 15 years that I've seen this, maybe one other time I can think of where we have really rates this low where we're, either teetering below 3% or slightly above it. So rates have been great recently. I think that's going to continue. Fannie Mae and Freddie Mac and even FHA have come out recently and said that they believe with the economic environment that we're in to bring, like it typically does when we see a recession or a dip in the market, housing is usually the one that leads the way. And how we do that, and they're going to keep on to push for this, is to continue to see rates low. So the projection is to see interest rates hover around or just slightly below the 3% range all the way through 2021, which makes it a great time to buy. Obviously, 80% of Americans, their wealth is in their homes. So taking advantage of that wealth, whether it's to buy another property using the equity that you have in your home currently, or using it to pay off debt. I mean, to be able to wrap in any debts that you have on a high interest revolving level is always cheaper money and becomes a tax deductible for you in doing the cash out transactions. Recently, what we've seen with the volatility in the market has been cash out transactions and some of the tightening, starting with those types of programs. When the federal government rolled out the CARES Act, allowing individuals to file for a forbearance on their mortgage, one of the programs that they will not insure for the lender are the cash out transactions.
We'll get to that in a second. So let me ask you this, Jason, just touching one last point on interest rates, and then I want to swing over to the difficulties that we're seeing getting different types of loans right now. So Jason, a common question I get is, Jared, my interest rate is X. Should I call a lender right now to just simply improve the rate that I have? What number would you say that people right now should be considering a refinance?
Sure. I think if anybody's got anywhere from 3.5 to 3.75% right now on their mortgage, depending on what type of loan it is, whether it's a government loan or conventional loan, is when you should really be reaching out to your lender to be able to see what options are available for you today.
Wow. So I thought you were going to say 4.5, 5, something like that. you're saying if they're above 3.5 or above, they really should consider talking to you about this.
Sure. Yeah, the government programs especially, those rates are always a little bit better than the Fannie Mae, Freddie Mac loans, but we're seeing those rates anywhere from 2.625 to 2.75. So if you're sitting at 3.5, that's almost a full, 0.75%. Probably
Right.
save you a couple $100 a month.
That's insane. So I saw some press recently. Chase Mortgage is, jettisoning a lot of their loan programs. I've been on the phones with my own deals that we've shuffled to you lately, just out of an act of mercy and not having a home for somebody who's trying to buy my listing. It's not even my buyer. And the lender calls up and says, well, you need a 700 now in credit score, where they originally qualified with a 620 or something like that. So tell me about, some of the lending challenges that you're seeing right now in the market. And this might be really good news, I think, for a lot of agents, because agents sometimes, especially depending on the experience they have, they get turned down, or they send a buyer to a lender to get a loan, and the buyer gets turned down, and you're scratching your head thinking, I thought, a 675 or a 690 was a decent credit score. What would you kind of shape for me exactly kind of what we're hearing in the marketplace with lending guidelines and things as the result of the pandemic and economy changes?
Sure. Yeah. So, and it's probably one of the more common ones, as you mentioned, that you're probably hearing out there. Chase kind of led the charge in making a pretty bold move in moving to a 720 minimum credit score platform and 20% down. Will that ease up? I'm sure it will at some point when more certainty comes into the market. But as of right now, none of the changes that we're seeing in the industry are coming from an agency level. And when I say agency, I mean FHA, VA, Fannie Mae, Freddie Mac, which you might hear referred to as HUD is considered the government end, and FHFA would be the government organization running Fannie Mae and Freddie Mac. So the changes are not coming down from them. These are individual changes put on the loans based on each bank or lender that you're working with, based upon their appetite for risk in this industry and in this market right now. All of that stems from a number of different things, from employment, being able to forbear payment on a mortgage, which we can get into a little bit further down the road here. But it's just the appetite for risk. There's a lot of volatility in the market, and lenders are looking to be able to make sure that they can be protected from a liquidity standpoint and be able to stay in business to protect their employees as well as still help homeowners. But that's kind of the give and take, is you need to stay open, and when liquidity issues come into the market, as they are for many businesses, mortgages and mortgage companies are not immune to that. So we see those changes starting, and those guidelines starting to tighten up a little bit in what credit risk is available.
Got it. So kind of some layman's terms, if I'm hearing you right, basically the back end organizations that are really feeding the guidance in the market and regulatory agencies are not forcing the mortgage companies to make changes. That a lot of what we're seeing take place, so from the Bank of America to Chase to Fairway to any other company, each company has their own restrictions. We call them overlays in the business. They're putting rules in place that make it in most cases more difficult for the borrower to be accepted by the institution to fund the loan.
Yep.
And so the point is, they're now really varied. So John Smith could go and qualify at one company, and the next one could easily do the file. So it's really important for people to get that right now.
Yeah, it's one of those times where you should probably have one, or at least if for those people who never would, get a comparative quote, because they're comfortable with, their bank that they deposit their money to, have their auto loan with. Now more than ever, it's important for them to be able to have at least a plan B, and because things change daily. Today, what Chase is offering or what Fairway offers could look different tomorrow. It's really that, each day brings something new to us. So we're rolling with the punches.
Got it. So really good. So one of the things that I feel like is important for Florida's real estate market right now, and probably even more so than the past is the second home financing, vacation homes. There's a lot of vacation home ownership in Central Florida, and there's a lot of investment activity in Orlando just because ever since whenever it's just been an ideal place for investing. I'm hearing a lot of issues like Airbnb just laid off 1,900 people. Our short-term rental market right now is going to have some pressure because you can't rent a property out to anyone right now. Like you don't have an income. It's all expense.
Yep.
But that's going to lead us to opportunity because there's low demand. Supply is still where it is. And so there's going to be a lot of buying opportunity. I think people that have ever wanted to own a second home or rental property in Florida or buy an investment, you have harvest, it's available there. And I'm going to share that on another video. But let me ask you this, is there any changes to buying second homes and investments? And then kind of what is the loan to value? Like if someone did want to buy, what kind of, considering a US citizen purchaser, what's the deal look like right now?
Sure. Yeah. Good news is like you said, it's a great time to buy. Rates are really low. I think comparative for an investment property, maybe about 0.75% lower than what it was this time last year. As far as guideline changes, we've seen no overlays to second home or investment property purchases. So for a second home, it's a minimum of 10% down payment. Investment property, minimum 15%. So it's, as far as those opportunities are available, I mean, we've seen no changes on our end, at least at Fairway. To speak to other banks, I'm not sure where their risk level falls. But, on our end, we don't see any issues with those types of properties at this time. You can still use the projected rental income to even qualify, for a mortgage. So that's huge.
Jason, I heard that a lot of companies have jettisoned their cash out refinances. Some of them have added as much as basically whatever the rate was. They've added 4 or 5% on top of the rate in cost if they were to give you some of your home's equity back and refinance that out to you. Are you guys still giving out cash out refinance? And if so, are you adding 5% onto the rate, like guaranteed rate, some of these other companies I've heard of that are doing that?
Yeah, no, good question. I've heard the same as you, anywhere from 3 to 5%. We have not adjusted our interest rates when it comes to the cash out transactions. Actually, we feel like it's one of the most important times to make equity accessible. But right now, our only adjustment has been cash out to minimum 720 FICO score and no greater than 80% equity position on your home, which is our minimum changes. The credit score is probably the biggest, but again, it's all layering on the risk. We still want to make people and have that program available to them.
Awesome. Okay. All right. So Jay, about, I think it was about 8-9 days ago now, the director over Fannie and Freddie for FHFA came out and it sounded like it was a point of clarification for forbearance. And so for forbearance, I think a lot of people are familiar with the term, but if you're not, it's a partial abatement or a complete skip passing of your current mortgage payment. And usually the ranges that are being promoted now are offered between 6 and 12 months. And FHFA came out last week and clarified a point because folks were concerned that, hey, I'm in trouble. I can't make my payment. I could use the cash, skip 5 or 6 months. But then on month 7, for instance, in that case, they would be paying all those 5-6 months that they missed, plus month 7 on the return from forbearance, which was, if you do the math, at a $2,000 payment, it's like $14,000 lump sum you got to come up with after you've been in the dire straits that caused you to need it in the first place. So he came up and said, hey, everybody, we're going to put down guidance that says it's not going to be a lump sum due. And then there's going to be some other way of managing that shortfall, but it won't impact credit. Okay. So Jason, fill me in where I've missed anything. And as a mortgage professional, should everyone go out and get some forbearance? And then what are the pitfalls? Like, is there any downside to actually taking advantage of a little payment amnesty from mortgage? Yeah, sure. and taking and keep Neiman Marcus in business with some of the
right.
savings?
Right, exactly. Mark Calambria came out, the head of FHFA, and did give a bit of clarification. We haven't seen any direct guidance to the lenders yet, forcing their hand, or the servicers, I should say, forcing their hand on what to do. I think that the biggest misconception or lack of communication being provided to consumers right now is, what is forbearance? What does it mean? For starters, first and foremost, it is not deferment. Okay, it does not mean that it's deferred to the end of your balance. That's not been guaranteed, or that guidance has not been put into law, essentially, for all banks to defer the payment. So as of right now, even though the goal for them is to get to that point where a consumer can defer 3 months and then not have a fourth month lump sum payment, that directive hasn't been solidified. So at this point in time, it's a bit up in the air in how the servicers choose to deal with it. As of now, I have not heard of any servicer yet choosing, and without extenuating circumstance and documentation, to push it to the end. More than likely, what I think that we'll ultimately see done is a short-term recast of cents to the monthly mortgage payment. Where if you have, say, $10,000 that is now owed, that let's stretch this out over the next 12 months, adjust your mortgage payment accordingly until that is caught up. So there will be, in my understanding, an adjustment to the payment more than likely before there will be tack on 6 months to the end of the loan. But again, we're still waiting for more. I think they're still working through a lot of that because it got rolled out with great intentions, but not fully worked through. Obviously, unique circumstances, and they needed to move quickly to ensure people, you will not lose your home.
Right.
First and
So
foremost.
what do you why do you think that so there would be opposition to a really long delay of all that capital coming into the bank, coming into the lender, the servicer rather? Who would be the person that would be shielding against that? Like, is it the investor that they're concerned about? Like, behind it? I mean,
Yeah, the servicers and investors, and this is where we get into liquidity issues. Because if you view the company you make your mortgage payment to, they're more of a property manager for you. If you own a property, you've got tenants in it, they're collecting the payment and then sending you the money monthly for a small fee. The way those contracts are written, those servicers, they are still responsible for your payment to the investor, even if you do not make it, regardless of if it's from forbearance that the government ran out or not. So ultimately downstream, you're now affecting the bottom line of other companies as this moves along.
So I think I've read that FHFA said they're actually going to cure costs to the investor. So here's the deal. If this really can be in a full position to support people, then FHFA is basically going to, they're going to tap the Fed to basically just write checks, and then people will get the deferment, and it's like pushing pause.
They protect the servicers. They're looking to protect everybody downstream of that.
But it does seem like every lender, it's like, if you want forbearance, you need to call, obviously you call your lender, you call who you're paying your mortgage to, talk to them about it. And then everybody almost like, just like overlays we talked about a second ago, it's like almost everybody has a lot of their own decision-making capability at this point, until more news comes out, which they're calling misinformation, that the FHFA needs to, there's a lot of misinformation. This is what we really mean. So it seems like they're just trying to put some guidance out and then see if everybody will run with it. And they'll hide over here in the corner.
Right.
Okay, maybe everybody will just do this, and then we'll just stay over here. And then they give you a little bit more input.
Sure. Yeah, they definitely had to move quick. So I think, rolling out all the information to get the consumer informed, you don't want to jump into forbearance without having all the information. So I would suggest to everybody, before you do, is to call your lender to get the information. One thing we know so far, although it will protect you to not mark mortgage lates on your credit, the act of putting forbearance on the mortgage will be reported to bureaus, which will, at this point in time, until further guidance, it will impact your credit score. So your credit will go down. There will not be late payments recorded, but the fact that there will be the word forbearance on your credit can affect your credit score with the bureaus. Additionally, what we're hearing is, coming out of forbearance, as of now, most banks are starting to look to require 12 months of on-time payments before you can obtain new financing. Okay, so that could impact you down the road as well. I would, of course, forbearance in this situation has affected and impacted a lot of families, unfortunately. So if you're in a position where that needs to be done to help your family, to save your household, that's why that option's there. You know, for any individual looking to just to have 3 months of getting by on the mortgage payment, it's not what the intent is, and it'll do more harm than good to you and to the businesses out there that are affected, again, downstream, your servicers, the investors on that, the banks, because ultimately it will lead to credit tightening, which will impact you and everybody else out there looking to purchase a home, ultimately.
Yeah. And I heard that too. I heard that there's been stories now in the marketplace where people were planning on moving to another home. They put their house on the market, put it under contract, thinking I got great credit. But they're in forbearance, and
Yep.
they've sold their house. They have to leave it in 30 days. And when they get pre-qualified, the lender says, no, you're in forbearance. You have to exit forbearance, then make 12 on-time payments.
Correct.
Then you can return back to the market again and qualify for financing. So the point is, like, forbearance can have issues. And again, I personally, this is my opinion and probably will be wrong or right. It's balance of everything we're dealing with. But like, I really think they'll unwind that. Like, if that exists, like, it'll be like, there'll be 18 lenders and that will say, if you had forbearance, all good, come on board. And then it'll be 18 over here that won't do it. Right. So you guys will probably be the ones that do it.
As we get further downstream and things shake out a little bit, we get further along the other side of the bridge of the COVID, pandemic that we're seeing, things will start to ease up again. It's needing clarity. And when there's lack of clarity, then that's when you have, companies having to make drastic moves to protect, again, themselves, their employees, and to stay in business like anybody else.
Yep, absolutely. Yeah. So, and it was great advice. I think you're dead on with, forbearance is definitely don't do it unless you have to do it. It on its own, it's probably going to have its own amount of yarn ball, crap just to deal with to get into it and probably to get out of it.
They may come up with programs down the road like they had with the HARP program previously coming out of 2008, 2009 to allow homeowners that were impacted, with late payments due to the last recession to be able to find financing and get around those guidelines. But we don't know that at this point in time. Hopefully they will, but there's no guidance on that as of yet.
Got it. So do you have any insight on murder hornets and if they could cause any major issues to the lending market?
Not that I'm aware of as of yet.
Lowering rates.
Maybe Wu-Tang Killer Bees might.
And there's a snowstorm coming in May to the Northeast. I don't know if you've heard that yet. That's like, what's next?
Right.
What's next?
Yeah.
There's so many memes available in the world today.
It's a good time for it.
So kind of as we round out this call, Jason, with all the chaos, people are still planning to buy homes. There's just a lot of people. I'm talking to people every day, like next month, midsummer, late summer, the fall. With the way market is now, like, when should a potential buyer give you a call in regards to actually getting this process started and based on planning and all that kind of stuff?
Sure. I again think it's a great time to buy. The moment that you think that you may be in the market to purchase a home is when you want to start looking. You want to have a clear roadmap to what it looks like to get to the payment, the affordability that you're looking for. Our main goal is to make sure that the consultative process leaves the client, educated, confident, and comfortable with the options that they have that best suit what their goals are and needs are for a home. But there might be some steps in between that application and that finish line to put you in the best position to achieve that goal. So nothing's ever cookie cutter these days, especially in this environment. We've got things changing daily. Better to be over prepared than under.
Very true. Now, there's a lot of buyers that we've had over the years that were, wanting to get out and have a house next month and then find that they've put themselves into a situation where their credit has got a 4-month process in front of it, which doubles, triples, puts their time frame out of their goal. So always advisable to call. So I'd also encourage agent partners, as you start to hit a lot of the roadblocks. Fallouts in April, I was tracking, was 50% of the new contracts on a given week. 50% back on market versus the pendings on a given week. There's deals coming unglued all the time. Jason personally duct taped a bunch for me last month. So encourage you to do that. Jason, I know you lend in California. You do a lot of deals for us in Orlando, partners here in Orlando. Do you serve any other states besides that, or is these your two main?
California and Florida are the two main that we focused on. We also have Arizona and Colorado at this time. Now, Fairway's
cool.
a national company, so I can always give a warm referral and definitely back up the work that will be done by any LO at Fairway. But for myself personally, California, Florida, Arizona, Colorado at this time.
Awesome. I know you're busy. You got some agents to train. We'll let you jam. So appreciate you being on the call.
Thanks for your time, man. See you soon.
Awesome.
Jared negotiated the sale price of our home $8,000 over the appraised value, and it sold in 2 days.
Make one call, that's all. Get your home sold guaranteed.
Jared Jones is the way to go. Call 706-5000. Jared Jones is the way to go. Call 706-5000.